Okay, all right. Let's get going. Thank you everyone for joining. This is the third webinar of that series on using Infometrics for various investment purposes. And today we're talking about choosing the right performance benchmark for infrastructure investments. So quite a topical thing, I think, at the moment. We hear about this quite a lot. So joining me today, there is Abhishek and Natalia, who you can see. Natalia is behind the scenes. She'll be running our polls, and Abhishek will present this webinar along with me. He will join us around halfway through, but maybe he'll be jumping in every now and then. We'll see. Anyway, I'm Frederick Blondrode. I'm the director and CEO of EDEC Infra, or EDEC Infra and Private Assets, as we're now known. And Abhishek is leading all the product development that we do. And so together we're going to tell you about how to use benchmarks. But first, quick word about what the organization does. For the past, let's see, close to 6 months now, we've been a regulated index provider. We've been providing indices for more than almost 3 years. But we're now ESMA recognized and provide and publish every month a range of indices. We'll talk about them today. We also provide a whole lot of investment analytics around private infrastructure. And for some of our users, we provide customization of these analytics. In fact, we'll show you a couple of examples of that today. And already, this is a system, a data platform that's used by the equivalent of 400 billion USD of infrastructure assets across a whole range of players, asset managers, asset owners, sovereign wealth funds, etc. All right, so let me start with the simple question, really, that we want to look at. What's the right performance benchmark? And as you would know, absolute return benchmarks have long been the dominating type of performance measure in this sector. In fact, we did a survey of that, some of you may remember, 4 years ago. It was quite a big survey of the whole industry. 130 people, organizations responded, and the upshot was that 70% of investors used absolute return benchmarks. And also that 90% were not happy about. So it was quite striking. And of course, the main alternative at the time was listed infrastructure indices or listed infrastructure benchmarks. And they were a lot less frequently used, but they were used and they're still being used. But they were also equally disliked. So there was a bit of this dissonance here in terms of the sort of benchmark that people had and how they actually felt about them. And I think at the time, it was mostly a matter of consistency. These days, it's become very urgently a matter of being able to correspond to the world that we are operating in, with very different levels of rates, very different levels of volatility. So let's start with a little questions. I have a couple of questions to get started with you to see where we're at now, a few years after this poll, this first survey. First, I'd like to ask the audience, Natalia, can you start the first poll, please? What do you think a good benchmark is? Is it a benchmark that's easy to beat? Is it a fair benchmark? Is it a benchmark that's hard to beat? Or is it no benchmark at all? Good for you, from your perspective. All right. I see quite a significant consensus, yeah? Quite a significant consensus.
There are a couple of outliers.
There's a cheeky one, yeah. Someone wants the benchmark that's easy to beat. Okay, and someone is a bit masochistic and wants to have a benchmark that's hard to beat. Okay, but everybody wants a fair benchmark. Otherwise, you can share those results, I think, Natalia, by now. Well, so that's the consensus, and I think even those 2 or 3 or 4 who answered something else, maybe it wouldn't take too much to convince them that a good benchmark is a fair benchmark. Okay, fair enough. All right, that was easy. Now, next one. today in your organization as an infrastructure investor, how do you benchmark your unlisted infrastructure investments? So we have the usual range: absolute return, a listed proxy, Inframetrics, which is new on the list. So the Infra 300 or some kind of custom index, or the Infrastructure 100 series. And something else, something based on appraisals, for example, or we don't have a benchmark. All right. So here I need a little more, please, a slightly bigger sample, please, before we can look at the results. It's interesting to see that, contrary to 2019, because it didn't exist, Inframetrics is now a major source of benchmarks, but we still have a few other cases.
And there's still not like a consensus on this point. Huh? There's still a lot of split.
Can we have a few more answers, please, in the audience? Assuming you have a benchmark because you invest in infrastructure. If you don't, well, obviously. Okay. So let's share those out. So this is interesting. So absolute return benchmark is much lower than it used to be. Listed proxy is lower, but I guess stayed there. Didn't really decrease in terms of proportion. Inframetrics, I suppose, has taken some market share from absolute return. Something else is very rare. But we know that building benchmarks with appraisals is an issue. We'll talk about that a bit later. And then there's a whole lot of people who don't have a benchmark. That's interesting. Maybe they're looking for one. Because, well, let's see. That's the next question, actually. The final question after that, I promise we'll give you a presentation. In your organization, what's the house view at the moment on your benchmark? It's fine. You've just changed it. Presumably it's better. We have to change it soon, or you don't want to have a benchmark. Considering that, I think 20% in the previous, more than 20% had did not have a benchmark. But I can see that very few do not want one.
It's a positive sign.
Yes. Okay, but I still need a slightly larger sample. So can you please keep answering? Okay. Couple more. All right. So the result is this. A third of you have a benchmark and it's fine, or you've just changed it. That's 40% in total. I'm guessing that's a lot of Inframetrics users in there. And a whole lot of you want to change it soon. Okay. Hopefully after this presentation, you have some ideas about that. Very few of you do not want to have a benchmark at all. That's also quite powerful, because again, many of you did not have one, according to the answers we got. Okay, so thank you, Natalia. We can put that away. So absolute return benchmarks have been less popular, right? Have become a lot less popular, but they used to be very popular all over the place. And you could very quickly wonder why. So one is that if you take a sort of cynical view, is that they were easy to beat because they were low, right? Because real rates were low. If you take a more pragmatic view, you can say, well, there was nothing else because we know that listed indices are not good. So there was no data. So we just did that. And then you could take a sort of portfolio view, which says, well, actually, the alternative to infrastructure was to invest in bonds. So we took bonds plus something, or real rates plus something, as an indication of the opportunity to invest in infrastructure. That's already a little bit more reasonable. But this has changed now, right? So easy to beat, no. Now, as you all know, CPI plus 500 basis points is a very large number, and Abhishek will show you some cases in a minute. There's no data. Well, no, there's not no data because we've produced these indices now for years, and they are now official regulated indices that are being used for all sorts of benchmarking purposes. And the idea that the alternative is for infrastructure is just bonds, and therefore you could just compare directly with interest rates, for example, or bond yield. It's not really. It's a bit simplistic. We did a paper on that last year. Which looked at the characteristics of infrastructure, right, compared with comparable benchmarks for stocks and bonds in terms of geography. And we found that infrastructure was neither like stocks or like bonds. And we use Inframetrics data, so it's monthly returns. You can see all the volatility, all the correlations. You can measure all the risk-adjusted and deep, even extreme risk characteristics of the asset class. And you find that it's a completely different asset class. And so it really deserves its own benchmark on top of being an alternative to bond. It's more like an addition to a true addition to the portfolio, plus and not a replacement of an alternative to bonds or stocks. Right. And finally, you could say that well, okay, they were absolute return benchmarks, and that was that for a while, and it's okay. It was the beginning of this asset class, and it's normal that things change. It's normal that things evolve. So there's no shame of having had an absolute return benchmark for a while. That's how things had to go for a while, and now that this asset class is growing, databases are developing, benchmarks are being created. At least if you're a sophisticated investor, now's the time to evolve, because the opportunity to do so is there. So when it comes to performance benchmark, in Inframetrics, you have 3 types of benchmarks, which we'll describe to you now. We have regulated market indices, so the indices that track the market. We have investor peer group benchmarks. You see how they're quite specific because they represent the style of a peer group of investors. And we have fund benchmarks, which also have their own use case. But before we go into this, I just want to make a quick point about why having a fair performance benchmark, and you all agreed initially that we want to have a fair performance benchmark. That's what a benchmark is supposed to be like, is a good thing for everyone. It's a good thing for not only those who monitor, and need a benchmark to make sure that things are going well, but it's also a good thing for those who are being benchmarked, in fact. So first, a benchmark. We all know what that is, huh? It's so in a dictionary, it's a point of reference against which you can compare something. So what is a fair benchmark? It's a representative benchmark. That's really paramount. Representativity is what we're aiming for here. And by this, we mean representative of the asset class and representative of the strategy within this asset class that has been adopted. Okay, so far, so good. That's easy. So fair means representative. Remember that. Representative means robust and granular. And these are 2 of our best friends, robust and granular, which we've introduced in previous webinars with Abhishek. Because representing the asset class means fair value, and because you're in fair value, you're also capturing the risk of the asset. You're capturing the variability of prices, so you're capturing the variability of returns. And that's what we mean by robustness here. Because if you can track these assets in fair value, you have something that's representative of the risk and the risk-adjusted performance of this asset class. And representativity also means granular because, of course, there are different segments of infrastructure. Not everyone invests in the same segments. And so you need to have enough data to be able to show what subsegments or subsectors in this asset class are like. And so, for example, if you invest in core, you're more likely to be investing in contracted infrastructure. So you need more data to be able to isolate what contracted infrastructure is like, for example. So that's what we mean by granularity. So representative means robust and granular. And if we can have both, we have a fair benchmark. So can we have both? Well, at least the point, I guess, is having a robust and a granular performance benchmark is important because that's what will tell us what the asset class is really like. So in that sense, it is in that sense that it is a benchmark. because it tells us what the asset class is like on average. So this is what you should expect. It tells you what you should expect in terms of returns, for instance. It tells you how risky this particular strategy, particular style is relative to other ones, other strategies, or even other asset classes. It tells you what's systematic in it. It tells you what's market driven in the performance and what comes from where it comes from in the assets. So for example, is the performance high because the assets in that particular type of infrastructure are very levered, or are they very profitable, or are they greenfield, or are they mid-market, size effect, etc. So all of these things which are systematic and explain in large part the performance. This is what you get from the benchmark. This is what you understand once you've analyzed the impact of the benchmark relative to your own performance. And if you've understood what's systematic in your performance, you've also understood what's not, meaning you can measure your alpha, which, hey, by the way, that's what you do in every other asset class. You have a benchmark, it captures the risk factors, the betas, the systematic effects that are driving the performance of the market. And whatever you're doing that's different from that is your alpha. As long as your benchmark is fair, then the alpha is correctly calculated, right? So this is where you actually measure the added value of the investment team. And that's why it's good for everyone, because it's good for those who delegate the investment. So whether it's the CIO who hires an investment team or an LP that mandates a manager, with this benchmark, they'll be able to, of course, understand the ability of the manager or the team to deploy the strategy to begin with, to invest, and then to add value relative to a benchmark. But for the investment team, it's really important as well, because otherwise what they're going to be judged against is really, in the end, going to be a matter of dumb luck. Because absolute return benchmarks are arbitrary. And as I'll show you, listed benchmarks are basically random when it comes to the performance of infrastructure, of unlisted infrastructure. And so, okay, in the past decade, maybe minus a couple of years, the luck was on the side of those who had an absolute return benchmark because it was very low and life was easy. Basically, you didn't have a benchmark really. But this is over. And so in a volatile rate and market environment, absolute and listed benchmarks have become serious liabilities, right? So the luck is turned, so to speak, and not having a fair benchmark for the investment team is also a serious problem. And finally, there's always this topic that comes back, which is that a good benchmark should be investable. And of course, that's in the definition of a good benchmark. That's what everybody's learned in finance class. A good benchmark is investable. And here it's not. Private assets are not investable as a whole. The whole private market, the private infrastructure is not investable in one shot. There's no ETF, or there's nothing like this. So you can't have an investable benchmark, at least not like that. It have to be quite an advanced type of financial product, perhaps a very well-designed fund of fund or something like this. But otherwise, you can't invest in those benchmarks. But they still have very interesting redeeming qualities, even though you can't invest in them, right? Because again, as long as they're fair, as long as they're robust and they're granular, they tell us what to expect from this asset class, right? And this is really vital to understand our performance and to decide how we want to invest. So, as I was saying, we have three ways to look at this in Inframetrics: the market, peer groups, and funds. So now get to that. Market benchmarks is something we've been doing for quite a while now. And just as a quick comparison, if you look at what sort of issues you would have had, if you don't have a market benchmark, you have an absolute return benchmark, you have something which is, for example, against CPI or CPI plus X. You have and you compare this with the expected returns of infrastructure or the realized returns of infrastructure investments. So on the left-hand side here, you have expected returns versus CPI in the UK, and on the right-hand side, you have realized returns versus CPI. So you can see that the correlation is low in the first case, 0 in the second one, and you can see clearly that these two things have nothing in common. They have no. So the absolute return benchmark are not representative of anything. There's zero fairness here, or zero robustness. And if you look at listed, it's something we've covered many times before. Similarly, you look at, here is one, it's S&P Global Listed Infrastructure, but there's quite a few. They all have the same problems. They all have this very strong bias towards North America, very strong bias towards energy, especially gas utilities, very concentrated, and more than often than not, because there's no clear definition. They're very concentrated in companies that are something to do with infrastructure, but not only. Previous life was quite familiar with Guangdong Investment, for example. I can tell you it's not just an infrastructure company. It certainly doesn't look like an infrastructure project to me. So that's also not representative, right? So what we do is a lot closer to what you need. Let me tell you a little bit where the Infometrics data comes from, because that's a very frequent question. Our data is a bottom-up database of asset-level financials. That means that we go and we look at the individual financials, the individual data, individual company that we analyze, and we produce a forecast for a revenue forecast and a dividend forecast on a very frequent basis. And this is the object of very extensive work by our data and analysis team. So it's done by humans. And this is where all the performance information springs from, along with a database of transaction prices, which are also reviewed intensively and extensively in order to calibrate a model of the risk premium. So I won't talk in detail about this today because that's not our topic, but once you have that, you have a database of financials, you can forecast cash flows, you have a database of transactions, which allows you to calibrate the risk premium for these types of assets. You can compute a net asset value, basically. Yeah? So for each asset, your future dividends, you discount them with an asset-specific discount rate, term structure of interest rate, etc. And you do this every month. That's what we do. So in a way, you could say that's what everybody else does, right? Every single appraisal, every single NAV that you see in infrastructure is the result of a cash flow forecast discounted with a discount rate. I think that's pretty well known. The only difference with what we do is that the data is more up to date than with quarterly appraisals. So the interest rates are more up to date, the risk premium is more up to date, and it's calibrated to the latest transactions. And the cash flow forecasts are also reviewed quarterly by a team of analysts. So it's the same than appraisals in a way, it's just better, but otherwise not fundamentally different in terms of approach. So that's what we've got. We've got prices, we've got NAVs for hundreds and hundreds of assets computed every month. We have this for a representative sample. So for example, one of our key indices, the Infrastructure 300, is not exactly, but all very closely representative of the entire universe. We have a universe which we've defined by reviewing 27 different markets. There's about 9,000 companies, and it's categorized by business risk, by sector, etc. And when it comes to this, we're not quite matching it perfectly, of course, because there's data availability issues and other things. But the point is we can be very close and we can be very granular. So that's a good thing when it comes to building a fair benchmark, a representative benchmark. And in terms of computing these values, these NAVs, the model that we calibrate, that we use, predicts a number every month for each asset. And when these assets actually sell, we find that the number is very close. It's usually within 5% of the price that the asset sells for. So what that means is that this market is a market. It's being priced according to a bunch of factors, which we have modeled. And given what the cash flows are like and where the market is at, you can actually predict the price fairly reasonably on a regular basis, and therefore build a robust set of prices, and therefore a fair benchmark, right? So with this Infometrics market indices, we achieve both. We achieve robustness because we have mark-to-market prices, and we achieve granularity because we have enough information on all the different segments of the market, right? So in the end, today it's something like, well, the regulated ones, I think, is 18 equity indices and 12 private debt indices. And of course, we calculate those in various currencies. So this is what our platform looks like. And they can be decomposed in terms of contributions and various other metrics, of course, because these are monthly returns for a market just like any other asset class. Right? So you can produce the same sort of results that you would with a bond index or stock index, etc. And one of the pieces of evidence that this is a good one, a fair benchmark, something that is being used, is the rate of adoption. So data that is now recognized by the regulator. We were saying that we've now been through all the hoops, and we've shown our models and we've shown our data to the regulator, and now they're okay to call our indices market benchmarks. It's also used by a whole lot of investors. I was saying this earlier. And our platforms is a very successful sort of data download, if you want, tool, which is used by thousands of people, and this data is downloaded a lot. So that's evidence, I guess, that those indices are indeed fair and useful. Now, I'd like to do a little extra board here, just to get your ideas on something, having described a little bit how you might build a fair benchmark. My question is this to you: is there an active market in which private infrastructure companies are traded as a function of supply and demand? Yes, there are common characteristics across all infrastructure, and so investors wish to buy and sell these things, and that explains in large parts the price. Oh no, all transactions are unique and have nothing in common, which is something you hear sometimes. The price of an asset is solely determined by the characteristics of this asset and whatever the buyer and the seller of this asset want. But there's no such thing as a market, so to speak. Or you're not sure. This is quite important because it might seem obvious to some of you, but the existence of market mechanisms, I would say, is almost precludes the idea of the benchmark, right? If there's no market, I'm not sure why you would want a benchmark. So we've had a fair few responses. Can we have a bit more, please? If you have an opinion, please give it to us, and we'll share it back with you. Couple more. Okay. Thank you, Natalia. So, right. So about 60% of you think that there is a market and that assets have a price because they have characteristics in common, which is basically the definition of the market. Otherwise, they're not in the same market. 20% of you are not sure. And some of you think that there is no market. All right, well, I'll get annoyed later about this one. But if you want my opinion, it can only be yes. But anyway, so let's talk about these market indices, how you might use them. Because after all, everybody invests in fund, right? So here I'm saying, okay, we have this asset level gross return. There's no fees or anything in there. Why would you use this as a performance benchmark? Well, if you think that there's a fair benchmark is needed, it requires acknowledging the existence of a market, and therefore that there are market forces, right? Because if you don't think that's the case, then I'm not sure what the fair benchmark actually could be. And even though you're investing in funds, the companies, the infrastructure companies, remain the underlying assets of these funds. From an IFRS 13 perspective, they're also the basic unit of account, right? So I know you're from an investment point of view, you're putting money in fund units or fund equity, but what the fund is actually doing is buying companies. So an asset level market index shows you the performance of the market as a whole, or this segment of the market, before there's any impact of the managers, before the managers select an asset or decide to buy it at a certain time or sell it at a certain time, or maybe add any kind of financial engineering at the fund level. So this is something that's going to be the fundamental driver of the performance of this investment, unless you don't think that there is a market. Incidentally, many LPs co-invest, so they actually invest directly in the market as well as in funds. However, you must, if you want to do this, if you believe that a market index is useful, you need to pick the right segment, because there are different risk profiles in the market. In this market, there are different types of infrastructure. And you want to pick the one that's the most representative for your particular case. So for instance, here I'm showing you the difference between 3 different indices that we run. There's the Info 300, which is global and tracks 300 assets around the world. There's a core index and an energy index. And obviously they've had quite different performance and quite different levels of risk. And so depending on what you do, the right market index for you is not necessarily the Infrastructure 300. It could be, for example, the core index, the Infrastructure 100 core, for example, which tracks the largest 100 core assets in our universe. Right. So that's one way to look at it. Another way to look at it, if really you want a market index that's very specific to a portfolio, maybe because there is no standard index that fits the bill, is to build a custom one. And so that's something we also do. So for instance, here, this is an example from one of our clients, but say you have a long-term investment kind of portfolio in various types of infrastructure in Europe. We want to build a benchmark that's representative of the strategy, right? So for example, we pick only infrastructure companies in European OECD countries, a choice of sectors that's based on the sectors that the client wants to invest in. And we pick something that's granular enough in the sense that it's customized, but it's not too customized, because if it becomes too granular, then it's quite likely to become noisy and therefore not to be fair, in fact. So here the choice that was made by our client is quite good, in the sense that it captures the segments that they're investing in, but it remains fairly broad. And so, for instance, it's defined like this in terms of countries and in terms of industry, etc. It doesn't really, it could be anything really. It depends on the client. And it becomes a fair benchmark, right? So with these inputs, we reweight the universe, we reweight all the different parts of the universe to build something that is exactly like their strategy. And as a result, it's fair. It's fair because it's robust, again, because it's the same data, and it's fair because it's granular, because it fits exactly the sectors and the geographies that they want to be invested in. I can't show you all the details, but basically you can see that it's actually quite a good strategy, in the sense that if you compare it with the broad market index, for example, on a total return basis since inception, it's been quite successful. Anyway, so to conclude on market benchmarks, you could say that absolute return benchmarks and listed proxies are not fair. And I think it was interesting to see how many fewer people use absolute return benchmarks now compared to 3 years ago. So they're not useful even for an infrastructure team now. And all the data now exists to allow the selection of a robust and a granular index to benchmark your infrastructure investments at the asset level. So why not? Now, beyond that market view, if you want to take a different perspective, we have 2 more perspectives: peer groups and fund levels. So I'm going to leave my colleague Abhishek to take over now and tell you about these two other products, and then conclude this webinar. Thank you.
Thank you, Frederick. And hello from my side as well. So now, having learned about market indices that we have in Infometrics, we wanted to give you another flavor of benchmarks that are designed for you to compare against your peers. And that's quite often a question that, yes, market is doing one thing, but as an infrastructure fund manager or as a pension fund, my focus is to compare against my peer group of investors, not necessarily always compare against the market. So for that, we use the same data that goes behind market indices and created a product that is designed to capture those different styles of investors. So if I take the example of the Canadian model, which is to invest in infrastructure assets directly, the Canadian pensions are quite sophisticated in this asset class, and they are quite active in terms of direct investment, in terms of their allocation to infrastructure. And we looked at the annual reports of 3 Canadian pension funds: CPPIB, CDPQ, and OTPP. What we found was, in terms of the benchmarks, they rely on a mix of listed proxies or absolute return benchmarks. And you can see that in the first table on the right here. So even though they are quite sophisticated in infrastructure, they're investing directly in very large infrastructure assets, their choice of benchmarks are still based on those old notions. And we will touch upon that, why that creates a problem. Also, if you look at the average discount rates that are there in the annual reports, they're quite different. And also they are not very easy to compare, that where these discount rates are against the market, what do they mean in terms of the performance. So if you look at the performance of OTPP, we found that in 2022, the Ontario Teachers Pension Plan, they actually had the highest performance of these three investors. But if you compare that against the benchmark, their outperformance was the lowest. And that's a question here. Is it really fair to show an outperformance of 3.5%? And that's supposedly because of their choice of benchmark. Had they used a proper market benchmark and others were also using a proper benchmark, the outperformance could be compared fairly between different investors. And second point is that this is only the comparison of return. There is no measure of risk in this comparison. And to assess the performance fairly, your return has to be adjusted for the risk that you hold in your portfolio. And that's not available with these comparisons with absolute return or listed proxies. So we took a deep dive and looked at the annual report of CDPQ and their yearly performance to just look at how these listed proxies can be an issue to compare against. So there is a very good example of that. We took the example of 2019 and 2020 year returns, and we see that the portfolio between these 2 years, it didn't change very extensively. There was an increase of 4 billion in the portfolio value, but arguably the strategy didn't change drastically, the investment team didn't change drastically, and so on. But if you look at their spread against the benchmark, it was completely opposite from 2019 to 2020. In 2019, they underperformed the benchmark by 10%, and in 2020, they outperformed it by 5%. And now this doesn't tell you anything about how the portfolio is doing, because you don't have a benchmark that tracks the same market as you are invested in, as your investment strategy. So without your portfolio changing a lot, your spread against the benchmark can be completely different. And this is the example, this is the argument that we were making initially, that listed benchmarks are a bit meaningless when you have to compare your performance and assess how you are doing against the market. So to counter this, we created this Inframetrics peer group benchmarks product. So the first step of this is to collect the data. We ran a survey together with Boston Consulting Group to determine the TICS allocation of 690 investors in infrastructure. And we created the peer groups for those investor groups. So by Canadian investor, by US investor, by UK pension funds, and so on. So we have 16 peer groups defined based on those allocation criteria. And then we looked at the average allocation within each peer group. So if we have data on, 50 peer groups in Canada, 50 investors in Canada, we took the average of that and called it the average allocation of Canadian investors. And then we use the same data that goes behind any other Inframetrics product, the market indices or so on, the same asset level bottom-up data. We use that to create the benchmarks that track those TICS allocations for that average group. So this way, the benchmarks are again very robust because they are based on the same fair values. They are granular because they track the different styles by these TICS categories. And we created the benchmarks that suits each investor style. So using this data now, using these benchmarks, we can rank these different peer groups against each other on a monthly basis. So the ranks keep changing as in how the different segments of the market evolve. We also publish different analytics. So understand where the return is coming from. Is it being driven by the capital growth or income? And how does it compare between different peer groups? That's all possible with this product. You can understand about the risk factor exposure. So where the discount rate is being driven from. If you have an expected return of 10% versus 8, why that's the case, which factors are driving those expected returns. All that information is possible. And finally, we also give you a decomposition of performance by those tick segments, so you can understand whether the return is being driven by transport companies, by renewable power, and so on. So all that information is available in this product, and that can be compared between these 16 peer groups that we talked about. So here's an example of that. We take Canadian investors, infrastructure fund managers, and US investors in this example. So in the first table, we are comparing their financial performance. And in the second, we are comparing their performance contribution of different sector allocations. Now, we have just taken an example of these three groups, but you can arguably compare any other peer within a global style. That's whether they are asset managers or owners, or by their geography, where they are based, these investors, or by the type of asset ownership, whether they are sovereign wealth funds, insurers, or pension funds, and so on. And finally, by fund manager style, whether they are infrastructure specialists or multi-asset fund manager. In total, there are 16 peer groups, and for each of them, we have dozens of analytics. We have realized performance, risk metrics, expected returns, contributions, and so on. And all that can be compared exactly like this against each other. And we'll take a practical use case, how that data is used now for these. So here, I took the same allocations for the three Canadian investors, CPPIB, CDPQ, and OTPP, and compared that against the peer group of Canadian investors from Infometrics. So we show the allocation by different industries for these three investors against the peer group of Canadian investors. And this data allows you to make comparisons now, where the allocations are higher or lower and what it could mean for the returns for that investor. So for example, in CPPIB case, we see that they are more invested in pipelines and transport companies, whereas all the three investors, we see that they have lower allocation in renewable power as compared to their peer group of Canadian investors as a whole. So that's a finding that we can see by making such comparisons. And these comparisons essentially will explain why there's a difference in their risk return against the peer group. So it's a very, very provocative insight to understand how the portfolio is doing, where the return is coming from, and so on. Then we look at the performance, but if it were to not be measured against these absolute return or listed proxies, and instead the Infometrics Canadian investors peer group is used for that performance comparison. So in the first table, we compare their expected returns. So we have the data from CPPIB and CDPQ, but not from OTPP on the discount rates that they use for infrastructure. But with this data, we find that CPPIB, they have a lower risk tolerance. Their discount rate is lower than the Canadian investors peer group as a whole. And of CDPQ, that their risk tolerance is a bit higher than the peer group average. And that may have implications into how their portfolio is performing, how their allocations are tilted towards certain sectors or businesses styles. And in the second table, we see that it's only OTPP that can meet the peer group benchmark. The benchmark has a 15.4% return, and only OTPP comes close to that benchmark. So that allows you to ask the questions why that's the case. Why does it not, why OTPP is close to the benchmark, why it outperforms other Canadian investors and so on. So you can look at the return drivers in the benchmark and understand how the different allocations of the investors could explain where the return is coming from and why one investor is outperforming others. So in the case of OTPP, we found that they have higher exposure in transport companies, and these companies have performed better than other sectors in the past year. And that's what probably leading their performance that's higher than other Canadian investors. So just to conclude the peer group benchmarks and how this style analysis is powerful. So first of all, with a mix of benchmarks, so somebody is using absolute return, somebody is using listed proxies, it's not always possible to compare, even within the same peer group. What is the real Canadian model like, for example, that if all of them are investing in direct infrastructure assets, why these performances are so different? So you have to understand the allocations. You have to compare them against a common benchmark that's representative of that whole strategy, and then try to make some conclusions on it. The second point is, if investors need to be comparing their performance, then they can use this kind of peer group product or peer group benchmark, but the performance can be compared not just by returns, but also on a risk-adjusted basis. And that is a very important conclusion into why the return is at X level or Y level, because the risk is so and so. And finally, the point that we have been highlighting so far, this data isn't very different from any other market indices. We use the same bottom-up fair values of infrastructure unlisted companies and use that to create these benchmarks. So it's robust, it's granular, and that's how it's used to create these peer group benchmarks. The third product that we wanted to talk about today was the fund benchmarks. So obviously a lot of investors invest in funds directly rather than directly accessing the infrastructure assets. So for those investors, the key question is to compare and assess the fund's performance, to monitor them on an ongoing basis. And the challenges that historically they've been faced is with contributed data. So we looked at this data quite thoroughly, that why this data creates problems. So first is the sample itself is not good enough. If you want to use this for manager selection or monitoring purposes, the data needs to be robust. The sample needs to be big enough that it gives you some concrete conclusions. And if you look at one of the contributed fund database, that's from Preqin, the average number of funds in any given vintage year are very few. The samples are just too small. The contributed data is also biased depending on who is reporting the performance, whether it's an LP or GP of the fund. And also there's survivorship bias. A lot of times the poor performing funds, they don't report their information. And with this small sample, there is no possibility of having any granular data. You can't compare within a core strategy, for example. It's just not there. You have 20 funds in any given vintage. You can't break it down further by strategies. So whatever quartile rank you will get out of this data, it's going to be lottery. It could be anything, depending on what funds you are using, how big the sample is, where the sample is coming from, and so on. And we'll talk about that in a bit. So that's a question. So it's not a poll really, but we wanted to ask you that, have you ever considered this question? How many infrastructure funds are there in the data? If you look at, per vintage from any contributed fund data set. And what we found was it's between 15 to 20, no matter whether you are using the data from Preqin, Burgiss, or any other data provider. The challenge is that there are not enough contributed funds in the market to create a sample that's large enough to give you a very good representation of your quartile ranks. And this example we try to explain through a very simple illustration. So we have taken a normal distribution of performance here with a 10% mean, 12% standard deviation of returns. So just to explain the chart a little, if you look at the first set of data on the under the 10 sample of funds, so 10 observations, we created the distribution of fund returns. So the first horizontal bar is the lower quartile, the second horizontal bar is the median, and the third is the top quartile. And these range explain the 95% confidence interval of each of those quartile boundaries. The problem is, on the x-axis, we try to increase the sample size. And as we are increasing them, we realize that the boundaries, the 95% ranges, they keep shrinking. So when you have 10 to 20 observations, it's not enough to explain where the quartiles should be, where the quartile boundaries truly are. There's a lot of overlap between the range of median, for example, and the range of top quartile. So depending on, again, which fund is included in there, if you take out one fund, your quartile boundaries can completely change and distort the quartile rank entirely. The same is true if you have 50 to 100. It's getting better, but still less precise. Only when you have a very large sample of observations, you start to find that the quartile boundaries are very robust. The 95% confidence interval is very tight, and you get very close to the true quartiles of where the returns should be. So what we are concluding from this is, in order to do a proper quartile ranking, you need a database that's large enough, that has enough observations for you to compute the ranks. To illustrate this point further, we looked at the data from 3 top fund data providers in different vintages. So we have vintage 2012, 15, and 2018. And the data comes from Burgess, PitchBook, and Preqin. First of all, the spread is quite large. We have up to 192 and 290 basis points spread, depending on which vintage you look at, which data provider you look at, and so on. So if you're trying to assess that this fund is in the top quartile, how can you be sure? Because the sample itself is so small. And the second problem is, again, what I mentioned earlier. With this small sample, you can forget about thinking about granularity and creating a benchmark that's specific to a fund strategy. It's just not possible. So the solution is Inframetrics Fund Benchmarks. It has 15 plus vintage years. So it goes all the way back to 2005. So you can compare any vintage strategy. In terms of the strategies themselves, we have 100 strategies in total. So you can compare against core funds. You can compare against a sector-specific funds like a renewable energy fund and so on. The data is robust. We have 1,000 observations within each vintage and strategy. So it gives you a large enough sample to make an assessment of where the market is at. The fee combinations are possible. So you can compare the fund against the specific fee range, management fee, performance fee hurdle of that fund. And then the metrics are also what are typically popular in the closed-end structures, IRR, TVPI, public market equivalents, and so on. The benefit is that this data is not biased. It's statistically sound, it's robust, and it offers the granularity that you need to compare different types of funds, different fund strategies. Just a quick note about where this data comes from. It's coming from the same asset prices that are used in any other Inframetrics product. Again, I would stress on this point that we do the same fair valuations of unlisted infrastructure companies. And we assume that, let's say these funds were to exist in the market, that they buy and hold the assets that are available in the market. We assume that they collect the dividends from these assets while they hold them, and then eventually they exit those deals. So the structure is very similar, but the underlying assets, the database is still the bottom-up data of Inframetrics. So we start from the same asset prices. We look at the realized dividends that are there in the financial accounts of these companies. We take into account certain assumptions on J-curve, fund size, the dry powder that's out there in the market to determine how these funds have evolved over time. The size of funds have changed over time. There's a J-curve in the initial investment period and so on. So all those goes in creating these fund structures. And finally, we assume that now these thousands of funds can exist in the market. We simulate over these different parameters of fund size, of J-curve assumptions, dry powder, and so on, and create thousands of funds within each strategy, each vintage, so that it gives you a fair sample to compare against. The result is that it's a very robust benchmark. We have many, many observations, and it's granular that you can compare against the specific vintage or strategy that you are after. It's a fair benchmark, essentially. So we did some proof of concept. So on an individual vintage level, we showed you that the data from contributed funds is not, contributed fund benchmarks is not good enough. It can be anywhere, but in aggregate, we wanted to show you that the data can be used for backtesting purposes. We looked at the data from different providers. We get between 200 to 30 data points across vintages. So that's good enough to create some estimate of quantiles, the chart that I showed you earlier. Anything beyond 100 observations, you start to get tight ranges for quartile. And this is useless for benchmarking, of course, because you want to compare within each vintage, within each strategy, but to do a backtest, you get good enough data. So here we have observations from 3 data providers and against Inframetrics. You can see that the quartiles, any quartile boundary is quite tight, and it's in line with Inframetrics. That is, on an average, Inframetrics predicts the numbers that are very close to long-run averages. And the data is robust, granular, so within each vintage, it allows you to make those comparisons. Now, just to wrap up quickly, I'm conscious of the time. We have two use cases that I wanted to show you for fund benchmarks. First, if you want to assess a manager, if you want to assess the performance of different funds, how they're performing, you can use this data. So here in this illustration, we have taken the track record of 2 fund managers using their actual fund data and benchmark them against the Infometrics fund benchmark. So on each bar, you have the quartile range from Infometrics within each strategy, within each vintage that's available on the y-axis. And then we have highlighted where the funds lie from the respective manager. So each fund is benchmarked, as I mentioned, against the same vintage, strategy, and fee levels. And we find some important conclusions. That manager 1 has 1 fund in the top quartile. That's fund 2 from manager 1. 1 fund is in the bottom quartile and 1 fund is in the second quartile. So overall, not the best manager, but also not bad either. And if you compare that against manager 2, the overall returns for all the 3 funds are lower as compared to manager 1. But each of their funds are in the top quartile. And that's an important finding, that even though on an absolute level, if you just look at returns, the manager 2 may look inferior because they have lower returns. But when you compare them against the benchmark within that strategy, within that vintage, you find that their funds are in the top quartile. So manager 2 is actually a good manager on a relative basis against the market. Second use case is to track the performance of funds. So here we have 2 funds with the same strategy, same type of fee levels, same vintage. And this is, again, actual data of the 2 funds. The way they have performed over time, they have diverged quite a lot in performance. So one fund has moved from Q4, the top quartile, all the way to the bottom quartile, and the other fund has gone to the top quartile. The problem is that while these funds diverge, this kind of fund performance tracking gives you an idea that where these switches happen and allow you to engage with the fund manager. That if the 2 funds have the same strategy, how can they 2 differ in the performance that much? It allows you an option to manage these risks in the funds by discussing that with the fund manager, or as a manager yourself, you can try to understand why the fund is performing so differently from the market. And Infometrics data allows you to do that. So just to conclude on fund benchmarks, we found that there can never be enough data to benchmark investment funds. There are not enough investment funds out there. There are not 1,000 funds in any given vintage. So there is no robustness or granularity that's possible if you just go by contributed data. But what we can do is create this robustness and granularity that's needed for fair benchmarking using the data in Infometrics. It has the same asset values that go in, so they are marked to market, etc., and they give you a very powerful and credible database to compare rather than using a contributed fund data. So now, the recap of the webinar. So I'm going to just touch upon some key takeaways for you today. What have we learned? It's time to pick a best benchmark, a fair benchmark for the whole team. And a lot of you have already accepted that you want to choose a better benchmark. So historically, this was not possible. The data wasn't there. The most benchmarks used were not fair, as we have talked about in the survey, or you have also accepted through these poll questions. And today, the problem is the same benchmarks, they've become unsustainable. The rates are that high, the inflation is very high, and to compare that against infrastructure investments is rather an unappealing argument. It doesn't work. And there's nothing wrong in it. It's normal because the asset class has matured a lot over the past 15, 20 years since these benchmarks were set. So as it matures, the data becomes available, that it gets more standardized, and the practices evolve. So we are at this cusp of turning, where we are offering the data through Infometrics, which allows for a fair and sophisticated analysis. So if you are a sophisticated investor, you can use this opportunity, you can use this data for better benchmarking purposes. And with that, I am slightly over time, but we will end the webinar. If there are any questions, I'm not sure. Let's see. Okay, I think we have answered most of them.
Yeah, we answered most of them. So thank you, everyone. Thank you, Abhishek. Thank you, Natalia.
Thank you. And if there are any questions, please feel free to reach out to us. We'll answer them offline separately. Thank you.